Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Thursday, June 18th, 2026, and markets are moving on a major geopolitical development. A US Iran peace deal is reshaping the macro landscape this morning. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant story is clearly the US-Iran peace deal, and its ripple effects are being felt across asset classes. We're seeing the Dow up around 200 points, oil prices sliding back toward pre-war levels, and gasoline dropping below $4. That last point is significant because it has direct consumer sentiment implications heading into the summer. Stranded oil is now flowing out of the Strait of Hormuz, which removes a meaningful supply constraint that markets had been pricing in for months. Alongside that, we're seeing Intel surge roughly 7% on reports of a partnership with Apple on US chip design. That's a notable development for the semiconductor space, which has been looking for a catalyst. Nuclear-related names like Oklo and Centrus are also rallying after a uranium deal, and GE Vernova suppliers are nearing breakout territory on data center construction demand. So across the board, there's a broad risk-on tone, though it's not uniform.
That's a wide-ranging set of moves. What's the tension point you're watching most closely?
The dollar, without question. Even as equities are rallying on the Iran deal, the Fed is sending a hawkish message, and the dollar has hit a one-year high on rate hike bets. Japan is already warning about yen weakness, which tells you the dollar's strength is broad and meaningful. That creates a split narrative. Equities are celebrating the geopolitical de-escalation, but the macro backdrop from the Fed is tightening financial conditions. There's also a Bloomberg report worth noting that big tech's AI spending spree is crowding out stock buybacks, which adds a layer of complexity for equity valuations in the back half of the year.
So we have competing forces. How are you reading the index levels technically?
On the S&P 100, we're pushing into resistance territory after this morning's gap up. The peace deal gave us a clean catalyst, but I'd want to see follow-through volume before calling this a sustained breakout. The Dow's 200-point gain looks constructive, but it's largely energy and defense rotation playing out, so the breadth isn't as clean as the headline number suggests. The Nasdaq is the one I'm watching most carefully. It's benefiting from the Intel news and the broader tech lift, but the dollar strength and the Fed hawkishness are headwinds for rate-sensitive growth names. Technically, the Nasdaq is sitting just below a key resistance zone, and a failure to clear it by end of week could set up a pullback early next week.
So the picture is broadly positive, but with some important caveats underneath the surface.
Exactly, the peace deal is a genuine macro positive. Lower energy costs are disinflationary, which is good for consumers and margins. But the Fed's hawkish posture is working against that narrative, and the dollar strength is a real constraint. Traders should be selective here. The energy sector rotation makes sense on the Iran deal. Semiconductors have a real catalyst with Intel, Apple, and nuclear infrastructure has momentum. But chasing broad index exposure at these levels with the dollar where it is, and the Fed signaling what it's signaling, carries more risk than the headline moves might suggest.
Measured approach seems right given those cross-currents. Now, Lizzie, let's move to crypto. What are you seeing in the digital asset space heading into next week?
The crypto picture is notably more cautious than equities right now, and that divergence is itself a signal worth paying attention to. Bitcoin lost the $64,000 support level following the Fed's hawkish announcement, and bulls are now defending the critical $60,000 level. What's interesting is that the Iran deal, which lifted stocks and bonds, did not provide the same lift to crypto, suggesting Bitcoin is currently decoupling from traditional risk-on sentiment in a negative way. The dollar index approaching a major breakout is Bitcoin's most immediate macro headwind, and Glassnode data does show capitulation is running about twice as weak as historical episodes, which suggests the sell-off may be losing momentum. There's also a notable long-term signal. Capital B shareholders approved up to $120 billion in financing capacity for Bitcoin strategy, which is a significant institutional commitment the market hasn't fully priced in yet. For next week, the base case is Bitcoin ranging between $62,000 and $66,000, with a 45% probability scenario seeing a drop toward $58,000 to $60,000 if the dollar breaks out. On Ethereum, the setup is actually more interesting from a contrarian standpoint. It's flashing a rare bottom signal while whale activity has collapsed, and Binance users are quietly boosting ETH8 holdings in the latest proof of reserves data. That combination of whale silence and exchange-level accumulation historically precedes meaningful recoveries. So ETH8's risk-reward looks relatively more favourable than Bitcoin in the near term, with a base case consolidation between $3,100 and $3,400. Solana is the most vulnerable of the three. It's sitting at a critical $70 support level, and if that breaks on volume, the next technical target is in the $58,000 to $62,000 range. There are no meaningful positive catalysts visible for SOL in the current news cycle, so the asymmetric risk there is clearly to the downside. The overarching theme across all three is that the hawkish Fed and dollar strength are creating a difficult macro overlay for crypto, and patience is likely to be rewarded more than aggression this week.
That's a thorough read across the digital asset space. That wraps up today's Morning Bell. Remember, do your own research and consult with financial advisors before making any investment decisions. If you found today's conversation useful, please subscribe to the Morning Bell wherever you get your podcasts. We're here every morning to help you start your trading day with clarity. Have a strong session, everyone.